afternoon, everybody. Welcome to Trader Merlin Show for your Thursday edition. We had an exciting guest yesterday, and today's guest will be equally as exciting. Actually, more so, maybe because of the timeliness of the content. As you know, Jerome Powell and the Fed made a decision yesterday to cut by 25 basis points. Everybody's expecting it to be another 25 in December, yet the talk track that was given out cast a little doubt on that situation. So we're going to talk about that. We'll talk about the end of quantitative tightening. Oh boy, do we go back to quantitative easing? I don't know, but we're going to have a bond market update with the resident expert, Mr. Bill Addiss, joining us from the East Coast. Bill, how you doing today?
I am great, Merlin. Great to be with you in the audience.
Always a pleasure.
Here.
Always a pleasure.
Sure.
Everything going good for you over there? I know you get your knee done. I tell everybody he got his knee done, and now he's ready to go play soccer again. I
am bionic, so I'm good to go. I'm 6 weeks into it, and I'm good to go. So thank you. I'm ready to hit the road again.
Yeah, absolutely. Well, we'll look forward to getting you out here in California.
I'll make it.
Every time that we have you on the program, not every time, but most of the time we have you on the program, it's right after an FOMC announcement. And quite often you're like, man, not a lot was said. Did this announcement of 25 basis points or anything that Jerome Powell threw out there change your perspective, make it, wow, this is a significant event?
No. Not on the interest rate environment. So, the market, and I think the market reaction shows that all of this was built in. I mean, talk about a yawn in terms of market reaction. Short-term treasuries were virtually unchanged on the day. The action was in the long end, where once again, rates actually ticked up a little bit. We'll come back and talk to you about that in a minute. But on the meeting itself, so that the expectation of that right in line, the only thing that he had all gave even a hawkish tone, if you wanted to interpret it, was saying that the future is not certain. There's no guarantee for December. So, that was the only slightly hawkish thing. The real news from an economic point of view to yesterday's meeting was the whole topic of quantitative tapering. Mm-hmm. This is something we've talked about a lot. And as you remember, in a lot of the meetings, QT has never even been in the discussion.
Right.
And this week it really commanded attention, as it should, because this is significant, what they've announced.
Let's talk about the quantitative tightening. Of course, I think everybody here wants quantitative easing, which means more money being pumped into the markets, and let's push it even higher. Quantitative tightening was a bit, designed to be somewhat constrictive for the economy, at least get some of the money back out of circulation that they flooded the market with. What does it signal to you if they're finally saying, we're going to stop December 1st with unwinding our balance sheet? Is there a message there?
Yeah, and I'm not sure why they're sending that message now. So just as a little bit more background, if I may, for the broad audience. So during the pandemic, as you all remember, the Fed just dumped boatloads of money into our economy under the umbrella of quantitative easing, where they literally dumped $6 trillion of new money into our economy because we wanted the American consumers to spend, basically, as the handouts were designed to do as well.
Yep.
So they literally flooded our economy. We were awash with cash. And that traditionally is one of the major causes of inflation. So the Fed knew that they were going to be creating for themselves inflationary problems during the pandemic, but they couldn't afford to care, because they had to worry about the economy first. Let's get up and running, then we'll deal with the ancillary problems. Mm-hmm. And that's what they've been doing since the end of the pandemic, is they've been reversing that process. So just like they dumped $6 trillion into our economy, they have been literally removing from our economy money, and that's what quantitative tapering is all about. So when they first started doing it, they were destroying, literally, $120 billion a month. That was at the most aggressive. Now, over the last 3 years, they've whittled that down to 90 billion, 30, 40 billion. Now they've been at 40 billion most recently. And what they announced at the meeting was they're going to discontinue the quantitative tapering. They're no longer going to be destroying money. And that's good, because if you think about it, since the Fed has been easing interest rates, that's a quantitative easing maneuver.
Right. This
destroying of money is actually a tapering maneuver. So at the same time, they were doing both. That's never happened in the U.S. economic history. It's kind of schizophrenia. They're both easing and tightening at the same time. And starting at year end, we won't have that any longer, because they're no longer going to be doing the tightening aspect. What I'm particularly, and this is where I get a little nerdish, so cut me off if you feel necessary. What I'm intrigued by about this is the whole mortgage component. How our Fed has been so active in supporting the mortgage market. And quite frankly, that's going to come to an end at year end. And again, if I'm rambling, cut me off, Merlin. But when the Fed started dumping treasuries into our economy back during the Great Recession, when they first started this idea of quantitative easing, they were buying a lot of mortgage-backed bonds and dumping money into the economy against that. And that made sense during the Great Recession because it was the mortgage crisis that kind of created the problem, right? The Fannie problems, the Freddie problems, we all lived through it. But yet, since 2013, the Fed has continued to support the mortgage market with aggressive purchases of mortgage-backed bonds. And I don't understand why. Well, I do understand why. I'm going to say cynically, you know why too.
Yeah.
The Fed is owned by the banks, and the banks have a vested interest in the mortgage industry. And I really think this is kind of payback by the central bank to take some risk off the bank's books and provide more capital.
Yeah.
So for the last 2 months, what the Fed has been doing specifically is of this huge mortgage portfolio that they have, and they have the largest mortgage portfolio in the world.
Over 2 trillion.
They have been yeah, exactly. They have been destroying 35 billion a month. So as $35 billion worth of interest and principal are paid to the Fed, they have literally been destroying that money. They're no longer going to be doing that come the end of the year. So it's going to be interesting to see the ramifications to the mortgage industry. There might be less mortgage money available. There could be. We'll wait and see. I don't want to be too in front of it. But it could create a little bit of a liquidity problem for mortgages at the start of the new year if you don't have the Fed there providing capital.
On that note,
I was long-winded. Sorry.
No, it's good. It's interesting because every time you come on, my brain goes down 15 different avenues of where do I want to get questions answered. And of course, I'm asking my questions, and the audience is asking a bunch here too. Right. With that scenario that you just painted, if the Fed is no longer going to be doing, unwinding mortgage-backed securities, right, what does that do to long-term interest rates? Because we saw a significant spike in the 10-year over the past couple of days, right? It was jumped pretty good. Granted, we still are in a downtrend. But if they stop unwinding, it's like this puzzle I'm trying to figure out, because you would think that by them unwinding, they're selling these portfolio products. That would add more liquidity to the market. That should cause yields to actually go up, if I'm not mistaken.
Well, yeah, think of it this way. Money, so you know this, money is a commodity like anything else. As money gets more scarce, the rate to borrow it goes higher, right? There's less of it available.
Right.
So if the banks are not going to be having as much mortgage money available, the rates that'll put upward pressure to rates. You're exactly right.
Well, There's our 10-year, and we've been talking about this one. For now, I'm still in the bearish side on the 10-year, just because the trend is so aggressively to the downside. Right, we've been making lower highs since this entire year has been lower highs, lower lows, except for that blip we saw back in April. But we had a really big surge up, came right back up to the moving average today, and you guys see this line right around 4.125. That's probably your next logical target, which we pretty much hit today, and we'll see if we respond to that one. But I had up here a chart for everybody. The first one, this is the Fed's balance sheet of mortgage-backed securities, and you can see a very consistent sell-off. Yeah, as you pointed out, they're unloading at a very predictable rate. That now is going to go sideways for a while. Right. Correct?
And what's going to happen is, and you'll like this because you're always looking for demand for treasuries, as I am, the money that comes in that they were destroying out of this mortgage portfolio, they're going to be reinvesting that money in short-term treasuries.
Right. Yeah.
So we get even more buyers for the short end of the marketplace, which also should put downward pressure to the short end. So, this brings up something I really wanted to stress with your group tonight is, and I do it all the time, sorry for the redundancy, but, the short-term interest rates and long-term interest rates don't move together.
Right.
And this week is a perfect example. The Fed dropped short-term rates by 25 basis points. And yet, as you said, and I'm just recapping what you said, at the start of the week, the 10-year Treasury was under 4%. It hit 4.12 today. So long-term rates are up about 13% from low to high. Short-term rates are down. The yield curve is dynamic. I got to remind people, back in 2024, the Fed dropped short-term rates by 100 basis points.
Right.
And long-term rates went up by 100 basis points that year. So, people who are trying to equate the Fed interest rate policy to mortgages are literally doing an apples to oranges comparison.
Right.
It's like trying to compare the price of Apple stock with Bitcoin.
Right. And you have some relationships if you go back to historical norms, which is you have a regular yield curve, right? If you have a normal yield curve, the short-term interest rates are very low. The longer ones are going to be much higher. And as the short terms rise, the longer ones should rise as well. There should be that dynamic. Unfortunately, now you see so much manipulation going on with both sides of it, right?
Right. Right.
I would argue that the 10-year is probably not as manipulated as the short end. But, from that perspective, let me bring up the yield curve here, the current one, just so we can all see that. No, it's not that feature. They switch things around on TradingView all the time. Here is the yield curve on TradingView. Right now you got the short end of the yield curve is still really high, 4.1 for the 1 month bond. What's going to happen here, and this is interesting because Jerome Powell was saying that new money that's coming in is going to go into the short term. So they're going to basically shorten the maturity of their overall portfolio and try to drop that time horizon down, which I think takes away some systemic risk for them. But that means that you're getting more demand for these short-term ones, which should cause these short-term bond yields to drop. And then you couple that with the new rules of the Genius Act, which say that all stablecoins have to buy short-term treasuries of 93-day maturities or less. And you have now new buyers for this. So it would not surprise me to see in the next year this short end, this 1 month, sub 4, my guess is probably close to 3.5 or maybe even lower, just because of so much more demand for those short-term products.
I agree with you completely. Absolutely.
Well, strange times, Bill. Very
strange times. Very strange times.
When Jerome Powell said it's not a foregone, he said a couple things. Number one, he was talking about how, while government is shut down, we're not getting a complete picture of data, but the data that is coming out, he said, was not. He said inflation is still a little bit high. He thought unemployment was starting to become a little bit of an issue, but there didn't seem to be any warning signs there. Do you think that this government shutdown and the lack of official government data is going to cause problems?
I think the problem is, yes, to answer your question. Cynics would say, well, how much have we trusted the labor numbers anyway? Maybe we're better off without them. I'm not that cynical. So, yeah, I'm a data guy. I want data. I also have to acknowledge that the economic impact of the shutdown, I think is just as dramatic. What are they talking about? $2 billion a week to GDP or whatever the number is?
Something like that.
So, there's an economic cost here as well. I actually feel for the economists who are trying to make forecasts in this market. I mean, look at the variables that are changing every day. Whether it's tariff policies with major trading partners that literally are still being established this week, so there's nothing definitive there. You've got quantitative tapering, which is something the Fed did that they had never done before. The idea of reversing all this easing, this is unprecedented. Even though it's spread out over a 4-year period, it's something the Fed has never had to do before. And then add on top of it a government shutdown. I mean, could you have enough variables, that we're trying to coordinate into some strategy as to where we think the market's going or interest rates are going?
Yeah,
I personally feel that long-term rates are going to go higher. I share your opinion, but let's face it, it has gone below 4%. Fortunately, it's only bounced there.
Yeah,
but it could be sub 4. We've been there in the last week.
Yeah, I mean, my I guess whole career of trading is based off the mantra that the trend is your friend until the bend at the end. And if you look at the trend for the 10-year yield, which I have up on the screen now, it's down. You could add any moving average on there, it's pointing down. You got all the highs from the beginning of the year are lower and lower and lower. We haven't broken a new low. And if we did it earlier in the year, we did a descending triangle on this bad boy. And that target brought it down to 3.75, which I don't think that's beyond comprehension to get there, right?
Yeah.
Certainly.
Yeah. Certainly within the realm of possibility. I personally feel long-term, the bias is more to the upside, but I can't deny, 3.75 is easily conceivable. I don't think we're going to rest there. The other factor that I meant to come back to, and I just, going through my mental checklist, when we talk about the Fed has stopped tapering and they're stopping to destroy money, you were a big proponent, or you were highlighting so much how much M1 went up during that period of pandemic, how the amount of cash in the U.S. economy increased by 500%. During that period of time. It almost looks like a misprint on the chart. I think I sent you a copy. You probably have one also.
I'm bringing it up right now because it does look like an absolute misprint. It's for me, it's one of the most dramatic charts I've ever seen. It is. Without understanding it, I think the average person goes, so what? It's like This is money in circulation, folks. We went from 4 trillion to literally 2 months later 16 trillion, and then we peaked out right around 21 trillion in May of 2022. Unbelievable. Like, what could possibly go wrong? If this was a medical diagnosis, let's say you're on the operating table and they gave you some morphine because you're in serious pain, they gave you 10 cc's, then all of a sudden it's like, you know what? Let's give them 400 cc's. Let's just jumpstart that heart. And, I think, Bill, most Americans are looking at it going, I don't care, because the market's gone gangbusters. My 401k is through the roof. I've got work. Things are great. It's booming. I got money. But my mind just cannot walk away from the fact that you can't make an adjustment to something so dramatic without ramifications.
And that's my point exactly. You're in my head. I mean, the question I raise is, as that chart shows, money supply has come down a bit. The Fed's destroying some. So M1 is going down slightly, but we are still miles above where we were pre-pandemic, meaning we're still flush with cash.
Yeah.
I mean, the U.S. economy is literally swimming in cash. So the question I would kind of raise is, why are we tapering?
Yeah.
Why are we discontinuing the tapering?
Why are we discontinuing, right?
Yeah, I mean, even the Fed's balance sheet. Hey, they've done a great job. At their peak, they had $9 trillion worth of bonds. They've brought that down to 6.6. That's great. But that's still way above where we were before the pandemic. So I'm kind of curious as to why the Fed has not been more aggressive even in terms of the tapering they were doing to get this money out of the system.
One of the tools that the Fed has, obviously, is interest rates to control inflation, which is one of their dual mandates. Tapering, in essence, is a way to fight inflation because you're removing dollars from circulation. And going back to my finance degree days, which I'm surprised my memory thinks that far back, one of the primary lessons I remember was when you add more money to an economy, when you flood it with money, you have more dollars chasing the same amount of goods and services. That drives up inflation. And you would think that tapering would be beneficial in helping us combat what he says is a persistently high rate of inflation. I question it as well. I would like to have heard more of an explanation as to why he thought it was a good time to quit the tapering. I don't understand it.
Yeah. I don't either. And, whether it's the Fed's balance sheet we look at, M1, you can make a strong argument that they should continue. But again, I do recognize that brings up this paradox that the central bank is basically working against itself. It's easing on the interest rate environment, but tightening on the cash flow environment.
And I step back and look at the big picture. And I always like to approach this market like it's, I use the example of a classic watch, one of the old vintage watches that you open up. And you might be looking at one little sprocket in there, but you have to understand what all those other pieces are. Because when one moves, it impacts something else in a dramatic way. And Luis says, that money ain't buying any crap anymore. Everything is so expensive. So we should care. We obviously care. And here's maybe my hypothesis on why they decided to stop tapering. So if you continue to taper, you're removing money from the economy, and that should start to have an impact on the price of goods and services because you have fewer dollars to buy those goods and services. Now, that sounds great because inflation would come down and prices would, in theory, start to drop. But here's where it becomes negative. That would be that these companies who have reaped tremendous benefits and vaulted this market to all-time high are the direct recipients of benefit from inflation, because they can now charge a higher price for their product. Their margins are starting to grow. And if we continue to taper and that money leaves the economy, that means less spending. We could see an economic slowdown where people don't buy as much. And these companies, I'll use an example, Habit Burger, right? In 2020, when I went to Habit Burger, a combo meal was like $8.30-something. Now it's $17 for the same meal. If people don't go and buy that, then the Habit's going to go, we're going to have to drop our prices here because we're losing business, right? We need to attract more people. And that may be why, because the long-term impact of tapering could be an economic slowdown for these businesses that have reaped the rewards of higher prices.
And you've hit the nail on the head. That is exactly the goal. They just like they dumped all that money in to foster more consumption. When you pull that money out, you're reducing consumption. You're absolutely right. Yeah. So, I mean, I can understand from that point of view because you've known me long enough to know I'm always an inflation hawk. I worry about inflation.
Yeah,
I still got to remind people inflation is still running at over 2%. We're at the 3% rate, and here we have the Fed cutting. So, there's a lot of crazy things going on in today's market. What happened to a 2% target? I guess it's gone out the window.
Gone out the window. Absolutely gone out the window. Well, I think we're going to see more uncertainty, more volatility. That was the theme for the beginning of this year, was just uncertainty because of the new administration. And then all of a sudden, like you say, we got issues with Russia. We got issues in the Middle East. We got China all of a sudden is now a foe again. We've got South America starting to argue with us, but now we got to bail them out and go, buy Argentinian pesos. Like, what are you thinking? Buy Argentine? They've got an inflation rate that's astronomically high, and you want to just buy their money. That's smart move. Smart move. Government.
We did, right? We did to the tune of $20 billion. Okay,
20 billion.
Just want to make sure.
Yeah, there was all kinds of weird. I read through it, and there was all kinds of weird provisions. Like, we didn't disclose at what rate we were buying it at.
Right.
And there was guarantees that they would buy it back at some point. I'm like, this sounds like a shady deal, man.
Well, and this is actually something I'm kind of proficient on because this is part of my business. I mean, understand there are 19 other countries that we do exactly the same thing with. And we've been doing that since the Great Recession. This is something our Treasury Department offered that didn't get a lot of press. But during the Great Recession, our Treasury Department said to other countries, central banks, you're more comfortable holding dollars? We'll sell them to you. We'll buy your currency, you take dollars. And 19 countries took advantage of that, and they all ponied up again and did the same thing during the pandemic, where they literally felt more comfortable holding dollars than their local currency. I think the number went up to 21. Wow. So what we're now offering to Argentina for political reasons is something we've done for economic reasons with many countries. And I got to be honest with you, this was done as a currency swap. We don't have the time or interest to get into it, but the transaction itself is a currency swap. We swap dollars for pesos for a set period of time. But on the book that we did during the pandemic at the Fed actually made $4 billion on that trade, doing those currency swaps, because the value of their currencies did rise. The value of the dollar went lower. So when they converted the pesos back to dollars, they were buying more dollars. We made $4 billion providing this stability to other countries.
It just seems strange that would work out, because typically if that country has low confidence in their currency, like for example, here is the U.S. dollar against the Argentinian peso, right? Which we just did $20 billion worth. This is, you might think that this is like a monthly chart going back years. No, this is just to 2024. And every day, it seems like, literally every day, the dollar gains against Argentinian peso. Lately, dramatic volatility. But what this shows you is the trend is your friend till the bend at the end. I'm not buying Argentinian pesos. So either the government knows you're buying a lame duck currency, you're swapping a strong one for a piece of garbage. There's got to be something there that says we can make this worthwhile, and that has to be some sort of economic, back scratching or something politically, because no one on earth would ever swap this trade straight up.
But the fact that the central bank is now holding on to dollars rather than local pesos, doesn't that give you a little bit more confidence in the currency?
It doesn't give me more confidence in currency because it's the way the country's run, right? So if the country's run shittily as it is, and I know that this one's definitely a political move, but if someone said to me, "Hey, I'll swap you $1 million for 1 million Argentinian pesos," I'd be like, "You're high. There's no way I would do that." Matter of fact, I'm going to short the peso because that's what the trend has been. It just seems foolish of the government to do that, but.
Yeah, and they have. And again, I point out 19 countries, including, by the way, during the pandemic, even the European Central Bank did the trade with us. We were providing capital to the European Central Bank. They felt more comfortable.
Yeah.
Strange times.
Steven says, didn't Maley just have a meme coin that came out and scammed his country out of $30 million? Yeah, so did President Trump, by the way. So let's not make it that Maley was the only one. So did Melania Trump, right? They both had meme coins which scammed people out of hundreds of millions of dollars. Oh,
yep.
There needs to be laws against these meme coins, guys, especially when the president tweets out about it.
Absolutely. There is. We just don't enforce the law.
I don't think there is a law.
Yeah, you can't do business out of the White House. Remember when Ivanka was doing her fashion business, but also her father's advisor? Mm-hmm. There is a law. I forget. We'll come back to it. You're not supposed, yeah.
You're not supposed to promote your own business. That's right.
Yeah, no, even Ivanka got into trouble. Remember, she was promoting Goya beans because the president of Goya beans was early supporter of Trump.
Yeah.
And she was out there supporting Goya beans, and she got into trouble because she was her father's advisor at the time.
Well, I'm sure they made a little bit of money on that one.
We've just decided to ignore that law.
What's the old phrase? It's better to say I'm sorry than may I?
Right, exactly.
Any changes, I know this is a left ball question, just totally from left field. Any changes in things like the repo market? And the reason I ask this is, You had mentioned in the past that the repo market was yielding about 4 to 4.2%. And it would seem to me that with these stable coins, they're designed to buy into three different markets. That's going to be cash with registered U.S. American banks. That's going to be into treasuries, 93 days or less, and participate in the repo market, all of which are offering around 4%. And what I'm kind of curious is, are we seeing any big changes in that repo market or any kind of cracks on the wall, if you will?
I am so impressed you asked that question because that's what I was queuing myself up for to want to talk about next. So you're right in my head. Yeah, and there are. I want to say there's cracks, but there has been some concern. So again, just as background for the broad group, the repo market, which most people outside our industry have never even heard of, this is not repoing cars. This is a financial vehicle. The repo market is the largest trading market in the U.S. It's bigger than the equity market, bond market, FX. Minimum, most days over $7 trillion a day trades in the repo market. And this is short-term cash investments. A repo is basically just a one-day trade, and it provides an interest rate for cash balances. So, for example, your audience, I'm sure all of them have money market funds, those accounts that sweep into a mutual fund so you can earn some interest on your cash balances. There's need to have short-term liquid investments. Money market funds love investing in this repo market. They're making short-term investments, and as you just said, the interest rate on these repos is pretty attractive, over 4%, or at least it was until yesterday. So this market has been huge from a demand point of view, but it also was a way the Fed was getting money out of the economy, because they were offering to money managers, insurance companies, hey, we'll do this trade with you. Just like we've always done this with banks. They opened it up during the pandemic, post-pandemic, and said, we'll do this with large asset managers. So Fidelity, Schwab, BlackRock are all huge participants in this market. And a lot of money is moving around. That's the bottom line. Every day, at least $7 trillion a day is moving around. Which lends to an argument of secure tokenizing this market to make all these transfers a lot easier. If you want to have that discussion. But be that as it may, the repo market has actually had some aberrations in the last couple of weeks that are concerning people because they can't really explain why. Because the repo market, and for those of you, I'm going to get nerdy again, the repo market, some of you might know, is what is called the SOFR rate, SOFR.
Right.
Because if any of you had a LIBOR-based loan or had a LIBOR-based mortgage, LIBOR's gone. It was replaced with this SOFR rate, the standard overnight funding rate. That's the repo rate we're talking about. So there's been a lot of distortions that some days that rate in the last 4 weeks has gone as high as 5%.
Wow.
And other days it has gone as low as 2.5%, I think was the number that was quoted to me. I mean, it doesn't normally have that type of volatility. So there seems to be an inordinate amount of cash, as we just said, in large volume, kind of slushing around out there. And that's, again, why some people are wondering why the Fed discontinued the tapering. This could lend an argument. We got to sop up some of that excess liquidity. So the repo market right now is one that people are looking at. The regulators are looking at it, trying to figure out, is it an aberration of liquidity? Do we have problems? Because a repo is backed by a treasury. If you're going to lend a company, you're going to lend the Fed money, they give you treasuries to hold in return. It's a very safe collateralized trade. So maybe the problem is on the collateral side, not on the cash side. But we are seeing some aberrations in the last couple of weeks that the marketplace can't explain.
Yeah.
Yeah.
Man, there's so many moving parts to this.
I'm impressed. You've been reading your news. I'm impressed.
Yeah. Well, it's just, again, opening up that watch again. When I look at the Genius Act, I'm really impressed with how it was structured by our politicians. And I'm almost embarrassed to say I'm impressed. To use that in a sentence, I'm impressed with how our politicians built it. Like that's impressive. We'll see what happens with the Clarity Act. But I love what it does for consumers. It protects them. It also gives the government a buyer of dollars. It also gives the government a buyer of short-term treasuries. So it's like a win-win. So on that front, I think it's pretty good. But, in my mind, I'm trying to figure out, with all investments that I'm making, is if this action does this, then what's the reaction and how can I profit from that, right? That's ultimately why I keep diving into these. Like, how can I position myself to take advantage of these changes in interest rates and policy and new tools that come to market?
Yep. And if I could just highlight, because we've been focusing, as I think we should, on the demand side of the equation. as it affects interest rates. And we got to make a good argument for a good demand for treasuries, particularly in the short end. I still have to add that cautionary note on the supply side. What the deficit's going to look like, how much overspending, will the tariffs help alleviate the deficit? So, if tariffs do succeed in minimizing the deficit, the government isn't going to have to borrow as much money. That also is going to put lower pressure on interest rates.
Right. Yep.
So a lot of things up in the air right now.
Absolutely. You talked about something before the show today, which I thought was interesting. You said the largest single bond offering ever today.
Yeah. Today was kind of in bond world. This was an interesting day.
He got excited. Bill got excited. He says,
Bill got excited. Doesn't take much to excite bond people, I guess. But as I'm sure your audience knows, Meta had their earnings last night, and Zuckerberg made a commitment to a lot more capex on artificial intelligence and so on. Well, last night after the press conference, I don't think it happened during the conference, they announced a $25 billion bond offering. And they did offer 6 different maturities of bonds, ranging from 5 years of maturity out to 40 years. Now, that's kind of unusual because 40-year paper here in the U.S. is very rare because the government only sells 30-year. So how do you price what a 40-year bond should be trading at? So there's a little bit of issues there. But be that as it may, they wanted to borrow money for 40 years, so they issued 40-year bonds. The deal... I'm sorry, go ahead, please.
I was going to say, do you happen to know what the yields on those bonds are? Because making a 40-year commitment
I haven't gotten the pricing. I don't have the final pricing yet. I can give you some indications as we go into the final deal.
Cool.
So over the course of today, now the deal was only announced last night. Over the course of today, on that $25 billion offering they wanted to make, they got $125 billion worth of orders in one day.
Wow.
And that's the largest syndicate offering ever. That size of 125 was groundbreaking. So as a result of that strong demand, they did increase the size of the offering to 30 billion from 25. I know that before the pricing, which is going on while I was with you, they were expecting the 40-year trade. Slow down, Bill. They were expecting the 40-year Meta corporate bond to yield approximately 1.3% more than the 30-year Treasury. That credit spread, you guys know that, was expected to be 1.30%, which I got to point out is very narrow. I want to wave a big flag here right now to everybody listening. Corporate bonds right now, the yields on them right now are horrible. They're horribly low. I mean, that's why Meta took the opportunity to issue these bonds, because those credit spreads are aberrationally low.
Yeah.
Corporate paper right now, whether it's investment grade or high yield, the credit spreads, the yield differential, are at the lowest point they've ever been. Why would you want to rush in and buy a corporate bond at those levels?
Here's why. Because
go ahead.
From a financial planning perspective, and this is what I think most Americans do not do, and they really should, is sit down, look at all their assets, look at all their numbers, and say, okay, how much do I need to live per year once I hit retirement? Obviously, calculating healthcare costs. Don't include Social Security because that'll be gone. Just assume that'll be gone. That's a bonus. When you do that, you should be able to say, okay, if I have $1 million, I need X amount rate of return per month, so we'll annualize that. And you could lock down and say, at this rate of return, I could live comfortably the rest of my life. So if I'm in that situation, right, and so, I'm only 25, but I could go out here, and right now that Meta corporate bond for 40 years, expiring August 15th of 2062, is paying 5.63%. If I know that I need 5% and I could live the rest of my life, then I would buy some of these corporate bonds, knowing that I have not a guarantee, nothing's ever guaranteed, but probably going to be around for a long, long time, and I now have a locked-in rate for 40 plus years. So I don't know. To me,
I would in no way want to disagree with that. I just like looking at this. I guess it's my old trading environment. I always like looking at things from a relative value conversation.
Yeah.
If I'm getting paid the leanest spread I've had to buy that type of investment, maybe I don't want to look at that. My answer would be, in a quick retort, mortgage rates remain stubbornly high.
Yeah.
That means mortgage-backed bonds are very attractive yielding right now. So I would try and redirect that income need to a market that's more attractive.
Sure.
Not all markets are equated equal. So yeah. I just would like to point out from a credit risk point of view, you're not really getting compensated for the risk that you're taking. But that
Agreed.
still might make it an appropriate investment in your scenario. I don't want to disagree with that
And
at
it
all.
certainly could be a piece of a broader portfolio. You know,
Exactly.
for me, I wouldn't do it. I'd much rather just be an option seller and collect premium. And you know, if I can make
Right.
if I make a 0.5% rate of return per month, which is pretty low risk, I'm going to beat this anyway.
Right. Yeah. Again, I'm not going to disagree, and you acknowledge the risk difference.
Yeah. Andre Sassy says,
Yep.
"Are bank reserves scarce?"
No, well, see, when you say bank reserves, I'm got to put you on the spot a little, Andre, if you have the ability to follow up. You know, when you talk about bank reserves, that traditionally was the amount of money that banks had to put on deposit at the Fed. You know, and they had a reserve requirement.
Right.
And the Fed paid the banks an interest rate on those deposits. There was an interest on reserve balances. Well, parenthetically and stupidly, in my opinion, and by the way, the reserves are meant to assure the safety of our banking system. So if a bank like Citibank is doing a lot more economic activity, they should have to have more money on deposit than a bank that isn't doing as much, or they're lending with higher credit quality investors. So the idea of a bank reserve was to protect our banking system. Well, during the pandemic, in a move that really surprised people, our Fed eliminated the reserve requirement. They literally said to the banks, you don't have to keep any money on deposit with us. And people in the credit world were just aghast at that because, I mean, let's face it, this was a time when our banking system was going to be vulnerable. And we said to the banks, you don't have to keep any collateral on deposit at the Fed. Now, the reason they did that, just to play the other side of the coin, was because they felt the banks were going to have to actually need that capital. That for them to put a reserve requirement kind of takes capital out of circulation.
Mm-hmm.
They felt it was almost like a capital infusion to the banks to say you don't have to leave any money on deposit with us. So that we don't have interest on reserve balances any longer. But the Fed does pay interest on excess reserves. So to answer your question, and I should have cut to the chase, the interest rate they're paying is still pretty attractive. You know, this is part of that repo market we were talking about. The way they pay interest on these reserves is through that repo product we were just talking about. Now, it sounds like you might know that. That's what generated the question.
Mm-hmm.
So that's the market that's showing some, I don't want to say cracks, but things that are not easily explained yet.
There's a lot of things that aren't
Long
easily
answer.
explained in these markets.
Isn't that the truth? Isn't that the truth?
All right, we'll wind this down. Liz says, but isn't the low credit spread a sign that the market is saying it is a safe investment in that metaphor, your bond, for example?
Yeah, no, I mean, the great observation. The credit spreads are market driven.
Right.
You know, they're not mandated, it's market driven. So we are saying that there is a lot of demand for corporate paper. You know, that credit spread is viewed as a signal of demand. So, and I understand it makes sense. There's another argument that says, well, if the Fed's going to be cutting treasury rates, maybe I should invest in the corporate market because even with the same maturity, I can pick up a little bit more yield.
Right.
So I understand why there's money going into the corporate bond market. But as a result, these credit spreads are now some of the narrowest we've seen. I just want to point to the group from a valuation point of view. The net result is of all this demand is the yields are just not historically attractive to what they usually are. Right. Maybe that's the way I should say it.
Yeah, and you know what?
Just
I'm
like this.
I'm not a financial advisor. I can't give financial advice, but I'll tell you what. If I had $1 million right now and I found that number to be attractive, 5.63%, there's no way I would buy those bonds. And here's why. As Bill said, these are historically low numbers. That's why Meta is issuing them right now, because they know they can get a sweet deal for 40 years.
Exactly.
If you go 3, 4, 5 years out, you might get a situation where a very solid company, maybe a Google, an Amazon, Microsoft, tries to do the same thing, and they may be paying you 7, right? Because of time, because of the time and demand for bonds at that time. Right now, it does signal a really nice future, right? Low interest rates signal that things are fine. As they start to rise, people are uncertain about the future, and then the yields get much higher for corporate bonds. So I wouldn't buy these personally. I'd wait.
Yeah. I'm not aggressively out there promoting. I always try to make a distinction between education and marketing. I was educating on the Meta deal. I didn't want to be promoting it.
Yeah. Well, I think, it speaks volumes to how do businesses grow, right? In a period of time where everyone is, kind of squinting at the amount of money that these firms are spending on AI, and I've been saying that a lot on this program, a lot, which is there's going to come a breaking point where they've invested so much money in AI and NVIDIA chips and server farms, and they're not getting that rate of return yet, right? That's going to be a breaking point I think the markets have yet to see. And that was actually part of the conference call for Meta. It was like, people are like, you're spending a crap ton of money on AI, you know. This is a way to further continue that spending, right? You issue some bonds, you lock in cheap money for 40 years. I think what this signals for Meta is Meta ain't going anywhere, right? Meta now has really big coffers. And here's the price chart of Meta today. Right now, it's only up 1.18% in the after. It was down 11% today. I was looking at selling some puts. We talked about that yesterday. But when I saw it open up well below that 690 mark, which is where I wanted to sell the puts, I kind of backed away from it. I was looking maybe at the 645. But knowing that they've got this money, or are going to get this money in billions and billions of dollars, that's a very good sign for the future. And keep in mind, it's not like these guys don't have cash on hand, right? Let me bring up the chart here.
Right.
There's companies with the most cash on hand. I think Meta's got, if I remember correctly, Meta's got, I think, $92 billion in cash. Phenomenal amount of money.
They're doing this because the rates are so low. They'd be silly not to.
Right. It's kind of like if you don't refinance your home and rates get down under 2%, you're an idiot. I'm sorry.
Right.
I've got a 6% mortgage, but I'm not going to refinance it too. Like, come on. Let's see. Meta. Wow, Meta's lower than I thought. So Meta only has 47 billion cash on hand. So I stand corrected.
Only.
Yeah, it's funny. Berkshire Hathaway is sitting on 344 billion. Interactive Brokers on 104 billion. I think that's the surprise for me on this list. Amazon's got 96 billion. Alphabet has 95. Microsoft has 95. Schwab was 78 billion. NVIDIA with 56 billion. Apple's got 55 billion. I mean, there is a tremendous amount of money sitting at a lot of these major financial firms. I think it's a good one.
And most of your high quality names on that list have come to market in the last year to borrow even more money.
Yeah.
For just the reasons we're talking about. The historical spreads are so low, they'd be almost fiduciarily irresponsible not to borrow it. I mean, knowing they're going to need it at some point.
Yeah. Wow.
And I think on the Meta play, the other thing that they played into so beautifully is they let you know at the onset of the marketing of this morning that 25 billion proceeds, which turned out to be 30 billion, was going to be used specifically targeted for AI and data centers.
Yeah. Right.
So you get both in one trade. You're providing the capital for two of the hottest markets going on now. And that's why they were able to build a book of $125 billion in a matter of hours.
Yeah. Crazy. Mike says, if inflation is 3.1% and bonds are paying 5.6%, I don't see the justification for buying bonds. Well, you would have a positive rate of return of 2.5%. Right?
But I would agree with you. That's not a lot. That's what I'm saying. The yields right now, it's hard for me to be a flag waver here.
Yeah.
I mean, you should expect even more yield given historical norms.
I look at the clock, and I actually have an hourglass here, and it's almost out, which means we should wrap up.
All right.
Tell me about your upcoming schedule. Where are you going to be? What's going on in your education world?
Yeah. We're doing the XLT. I've been enjoying. I really like these monthly sessions. So my next XLT, I believe, is the 28th. And what we're going to do on that is some spread trading. The way that a lot of people like to trade the market, the way I used to in my days, was not doing an outright position, but doing spread trading. Trading the 2-year against the 10-year. And doing what we call the flatteners and the steepeners. So I've been a real advocate of the steepening trade, which I have to admit hasn't worked for the last month. But if you do believe long-term rates are going to go up, like Merlin and I were just talking about, and short-term rates are going to go down, that means the yield curve is going to get steeper. And there's ways to trade that. And I like using the futures markets for that. So we're going to do some futures spread trading on the XLT class. And then December 6th, I believe, I have the last focus class of the year. That's the full one-day intensive class. And then on top of that, every Friday, although it's been a tough 2 weeks, we try every Friday at 2:00 for the people who are graduates of that focus class. We all get together once a week. So that's every Friday afternoon. So I'm spending a good amount of time with you folks, and I enjoy it. Nice.
Well, we appreciate you spending some time, not just in the XLTs or teaching the focus class, but also coming on this show and enlightening us on the Powell probabilities. I guess we'll see you right around December 10th is when we
Sounds
get
good.
the next meeting. And by the way, that was a 92% probability that there's a rate cut on the December 10th meeting. That has dropped from 92 to 72. Real quick, Jerome Powell
Really?
put a damper on that one, yeah.
Yeah. Hard to be data determinant when you don't get data. It's going to be interesting.
It's just speculation. I use there's a CME. The CME group has the Fed funds futures, and that has changed dramatically over the last 48 hours. So it's been pretty good.
Yeah. Fun market to watch. Remember when the futures markets gave us 8 cuts in 2025?
Love it. You just never know.
It's funny because always a pleasure talking with you. Well, I'm sorry.
I was going to say it's funny because right now the Fed funds futures, they're pricing them out to October of 2027. And it's like no one has a clue what's going to happen between now and October 27. 2 years out? No, not a chance. Good luck.
Let me get my Ouija board. That would be as good as accurate as anything.
Exactly. All right, Bill. Thank you so much.
Yeah.
I appreciate it. Take care, and I'll see you in about 6 weeks. All right.
Sounds great. Bye. Happy Thanksgiving to everybody.
You too. Bye.
Cheers.
Guys, that was Bill Addiss. He's got the Canary in a Coal Mine Bond series for Trading Academy. You guys can find out more information by going to tradingacademy.com or go out to his website, which I think I had it up here. It's aftraining.co. He's got all kinds of shops and videos in there, so check that out. Hopefully you guys learned something fun and new today. All right, man, my hair is just going so wild. My buddy's trying to convince me to not cut my hair, but it just looks so damn unruly. I don't know what to do with this stuff. That's why I like having short hair. I look like just disheveled homeless person right now, don't I? Yeah, I'm going to grab myself a shopping cart and call it a day. Let's go to our markets and work our way from the bottom to the top. It's getting perilously dangerous for the crypto fans here. Bitcoin closing down below that yellow box. It does not look good at all. Today was a really bad day. Down 3.77% for Bitcoin, closing at 106,955. But after those earnings came out, it started to pop a little bit. It's back up about $1,000 per Bitcoin to 107. Yeah, Andres, I do have hair volatility. I definitely have hair volatility going on today. So 3.77% slide for Bitcoin, but it's bouncing a little bit now. I'll admit I am getting pretty nervous here because I thought this last rally going into Monday, I thought we'd see more momentum to the upside, and we are not getting that. So that's not a good sign for the crypto markets. It makes me nervous that this whole 4-year cycle may in fact be in play. What's the cause on Bitcoin today? I don't know. I saw that there was a bunch of leverage liquidations, which has been the story for the past couple weeks on this, but I don't know. I'm not sure. I agree with Big Ollie. He says it's manipulated. Yep. I hope not, Steve. I hope it's not the 4-year cycle, because if that's the case, then we're going to be going down significantly from here. Let's just hypothetically go from the high, which we have just a few weeks ago, and pull down the average decline during a 4-year cycle for crypto, which would be 70 to 80%. A 70% decline in Bitcoin would bring us down to $37,000. What would trigger that? How could that happen, right? Could Bitcoin fall to $36,000? What do you guys think? Yes or no? Think Bitcoin could fall to $36,000? Personally, as I wait for you guys to type in because there's a slight lag, Mamon says shave my head. Not a chance. No way, bud. I have an ugly looking head. No way. Buy the Dip says no. Most of you saying yes. Here's the thing. There is absolutely a high probability. Not high probability. There's absolutely a possibility that this happens. And here's what it would take. We could probably do a little bit of research right now and find out what the liquidation price is for Michael Saylor and MicroStrategy. If we get to those levels, which I believe is down around 70,000, 60 something, let's just say it's 65,000, right? So let's put a line on here and just to have some fun. I don't know if this would be fun. I think a lot of people like this. Let's go 65,000. And again, we would adjust this to whatever the liquidation price is. So he would need to liquidate some of his Bitcoin at points to cover debt obligations. If that happens, that sell-off could cascade significantly, right? And right now, we're a long ways away from those levels. But if it gets there, that would start a massive sell-off. And that could really cause this thing to go all the way down to 36. It seems inconceivable, but it could absolutely happen. I will tell you that if it does get to 36, I will absolutely load the boat. I will, without a doubt, be into my goal, which has been to have a double-digit portfolio of Bitcoin. Right now, I'm still in single digits on Bitcoin. Unfortunately, I didn't make a chance to get all that I wanted, but I'm very close. I would definitely be in the double-digit category if we drop down there, but I don't think we will. It's just not shaping up to be a very pretty picture right now. I know I'm with you, Janet. No, please, no. Yeah. Well, we know it's extremely volatile. Is the 4-year cycle over now? technically it's supposed to end in November, so we'll get a better reading of that in November, but it peaked out in October. But next on our list, NASDAQ. So NASDAQ was looking ugly for a while, down 1.45% on the day, and now we have recouped a lot of this. If we go to our 5-minute, because of the earnings that are going on right now, the NASDAQ's having a nice little rip. And when I talk about earnings, of course, you got Amazon, which is up 13% in the after-hour session right now. Love that. You have Microsoft, which is up ever so slightly. No, they didn't report earnings. I'm sorry, Apple. Apple was down, then started to spike. It was up right now it's up 3.33%. But you also have, Netflix, which is reported a 10-for-1 stock split. That jumped at 3%. A lot of positive things going on in tech here. I didn't look at the NVIDIA chart, but my guess is it's moving up a little bit here as well. So I really don't, I'm not too worried about our markets tomorrow. I think that this could be a blow off top though, because you have a market will most likely gap up tomorrow based off all this good news from Amazon and Apple and Netflix as well. Right now, NASDAQ chart, But when we get the market to open up, we'll see what the numbers look like. So let me go all the way back up here to the top and get to the S&P. I opened a short position 2 days ago or yesterday. I forget when I opened the position, but I opened up an outright put position, I think it was yesterday, expiring tomorrow. And right now, that thing was definitely in the money. It was a great trade for me today. We'll see if I give back a bunch of that tomorrow when this market gaps up. But S&P was down 0.97%. Russell, a little bit better, but still, again, what I've been saying, it's still in that trend. So don't worry about the slight slide here in Russell. It's about that trend. Crude oil, a nothing burger today, is only up 0.15%. Not a lot going on there to speak of. Gold, a little bit of a pop at 0.38, but again, nothing really to speak of other than maybe a bullish engulfing candle. It's not quite a technical engulfing candle. I know you technicians are going to go, that's not an engulfing candle. It's close enough. Dollar index, 0.38%. This is the one that Bill Addiss and I were talking about a little bit. This is concerning because we broke that pivot high from October 9th. Now it looks like we're going to be heading up to that 100.25 mark. That should put downside pressure on the equity markets. And again, today we're seeing the dollar do what it usually does, which is inverse of the equity markets. Dollar had 2 strong days of rally. S&P had 2 strong days of sell-off. And our top of the list here was the 10-year bond, which is up 0.47% on its yield to 4.097. All in all, still in a downtrend, but not looking good. Liz says, did MicroStrategy report? Yes, they did. And they were up in the after-hour session 4%. But that doesn't really wipe out the big decline today. 7.55% slide for MicroStrategy. I still have the 245 puts on that bad boy, so expiring tomorrow. I also opened up a new position today, which I did not add to my spreadsheet, but I will do that one for you guys on tomorrow's show. Let me bring it up here just so I can remember exactly what trades I made today. I'm always all over the place with my trades. So let's go to, I did FI. You talk about juggling chainsaws. So Fiserv, right? These are payment systems. And keep in mind, this security was trading at a high price several months ago of $238. Now it's at $65. I sold the $62 strike today and collected $125, expiring next Friday, right? So I gave it about a week. We'll see. I think long term, I'm okay with this company. They did a board shakeup. They also had, they're pulling out of NYSE, want to move to the NASDAQ. So really, really, wild price drop here on their earnings. And they did miss earnings, but look they're still doing pretty good. They reported $2.04. They were expected to make $2.64. So this is a pretty big risky trade going on this one. I sold quite a few of these bad boys. We'll see how that one gets me. And I have the MP. I still have my MPs, but those expire tomorrow. I should be safe on that. Remember, my MP is a $62 strike. Today you had a nice up day. Currently trading at $65.38. So I probably will not get filled, which is unfortunate because I did want to buy some of this MP at that $62 strike, but unfortunately, I probably won't get hit tomorrow on that one. So there you go for my trades. And then I saw CMG pop up on the screen here. CMG down on the day, 18%, and they beat earnings, right? They were expected to make 28.6 cents. They came out at 29, so they barely beat earnings, but something clearly was said there and not looking so good. Yep, Liz, they did. Yep, they slashed their forecast in half. But remember, if you slash your forecast in half, and you're down from 260 or 200, what did I say, 260, 250? Something like that, 250, and now you're at 65. That's way, way over half. But yes, FI did slash their outlook. Yep. It's funny because you look for it on DeepVest. That would have been a good one. It's funny when you look at what the analysts have done. A lot of them have been downgrading FI, but not to a sell. They're downgrading it to neutral from a strong buy. And it's funny because a lot of their price targets are like $85 price target, $90 price target. It's like you realize we're at 65. So they're still expecting it to move up over time. Right now, I think it's just a pain moment. When you look at the volume on this bad boy, you can clearly see 91% of the shares are held by institutions. So there was a lot of institutional dumping going on here, and I think that just cascaded. And I think that Fiserv will probably be okay. But again, this is why you have different positions and you spread your assets around. Okay, in order to make this not a 1 hour show, I'm going to wrap up. If you guys have something you want me to discuss on tomorrow's show, you can email me at tradermerlin@gmail.com. Again, if you want to see Bill Addiss, he teaches for Trading Academy. You can find out more information by going to tradingacademy.com or go to his website, which is aftraining.co, to find out more information. And hopefully we'll have a great show on Friday. I'm looking forward to having a glass of one of the many bottles I received of whiskey for my birthday. So those of you that sent them in, thank you so much. I'm really not drinking much lately, so maybe I should tell the audience I'm collecting gold coins or something as opposed to whiskey. So anyway, thanks you guys so much. Hope you enjoyed it. I will see you all tomorrow for our October 31st Halloween edition. If you got a Halloween costume you're wearing, send it to me at tradermerlin@gmail.com. I'll put you on the show for tomorrow. See you guys. Take care.